old-fashioned belief that I can only should expect to make money in things that I understand. And when I say understand, I don't mean understand the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. You know, if you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. Understanding the economic characteristics of a business is different than predicting the fact that an industry is going to do wonderfully. And so when I look at the internet businesses or I look at tech businesses, I say this is a marvelous thing and I love to play around on the computer and I order my books from Amazon and all kinds of things, but I don't know who's going to win. And unless I know who's going to win, I'm not interested in investing. I'll just play around on the computer. And defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, "I'm no genius," he said, "but I'm smart in spots, and I stay around those spots." And you know, that is the key. So if I understand a few things and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, stocks are going up and everything, they start fooling around someplace else, eventually I'll get creamed, and I should. So now let's go over here.
Hello, Mr. Buffett. I got two short questions. One is, how do you find intrinsic value in a company?
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You know, you can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from them.
Good morning. I know you're famed for your success, but I was curious if there were any particular moments in your life that, or mistakes or failures that you've made that were particularly memorable, what you may have learned from them, and if you had any particular advice for the students here in dealing with discouraging circumstances.
Yeah, I've made a lot of mistakes. Biggest mistake, well, not the biggest, necessarily the biggest, but buying Berkshire Hathaway itself was a mistake because Berkshire was a lousy textile business, and I bought it very cheap. I'd been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap, and I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts, and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. And Berkshire was selling below its working capital per share. You got the plants for nothing. You got the machinery for nothing. You got the inventory and receivables at a discount. It was cheap. So I bought it. And 20 years later, I was still running a lousy business. And that money did not compound. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money. Time is the enemy of the lousy business. I could have sold Berkshire, perhaps liquidated it, and made a quick little profit, one puff. But staying with those kind of businesses is a big mistake. So you might say I learned something out of that mistake, and I would have been way better off taking what I did with Berkshire is I kept buying better businesses. I started the insurance business, Seize Candy, the Buffalo, all kinds of things. I would have been way better doing that with a brand new little entity that I'd set up rather than using Berkshire as the platform. Investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity. Just huge opportunity. I mean, I lived through roughly half, in an investing sense, about half that period. People behave very peculiarly in terms of the reactions because they're human beings and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime in securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but it doesn't take brains, it takes temperament. Things can go on a long time that don't make sense. And But they do come to an end. I mean, the internet thing, I mean, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herb Stein one time said, anything that can't go on forever will end. Now that seems pretty, but think about that. And particularly think about it next time you're trying to do something just because the stock's gone up a whole lot, and your neighbors made money or something. You've got to be, you just have to sit and think objectively and think about, would I buy this whole business? If it's an internet company that's got 100 million shares out and selling at 100, that's $10 billion. Is it worth $10 billion? If it's worth $10 billion, it's got to be able to give you, 700 or 800 million next year. And if it doesn't give you 700 or 800 million next year, it has to give you maybe 10% more than that the year after and continue to. There aren't a lot of businesses that can do that. And people just go crazy. And of course, it's fun. I mean, it's like that sign they put in brokerage offices that says, avoid hangovers, stay drunk. I mean, it's just so much fun to keep playing. But you got to do sensible things to get good results. But the biggest mistakes we've made by far, biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And I don't worry about that if it's Microsoft because I don't know it. Microsoft isn't in my circle of competence. And so I don't have any reason to think I'm entitled to make money out of Microsoft or out of cocoa beans or whatever. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting. But I know the cost of it. Those are the big, big mistakes. And big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it, and every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one the rest of your life, you would think a long time before every investment decision. And you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
Good morning, sir.
Hi.
Hi. I was wondering what your opinion is of the Federal Reserve and their actions taken recently. Do you feel they've done enough to boost the economy?
You have to understand one thing about the Fed is that it's not as powerful as the mystique would make it. Its brake is better than its gas pedal. When the Fed wants to put on the brakes, we go for the windshield. I mean, the economy just, they can put on the brakes. Paul Volcker did it. He broke inflation by doing it. But I mean, when he put on the brakes in that period around 1980, I mean, people hated him. He was crucified for it, but it was the right thing to do. And he could do it. He did it all by himself. And and it was the only way because of the momentum that inflation was generating. It was the only thing it was what was needed then. Enormously unpopular. It's much harder for a Greenspan to put on the brakes because nobody wants him to put on the brakes, plus he's so visible. But he's put them on sort of gradually. But stepping on the gas pedal, he does not necessarily get the same result. It may help, but there are 1,000 other variables operating. And as you see in Japan, you can get down to 0 interest rates and you can't stimulate anything. So it isn't like the Japanese haven't read the same books we read about economics. I mean, they've read Keynes and they've read the whole thing. So we're not smarter than they are. we don't have any secrets they don't have, but they don't know how to get their economy going. And, their GDP there has been going no place, in the last 5 years, and there's still problems around. So easy money doesn't solve everything, but Greenspan could very well get blamed for the fact that he hasn't solved everything, and it's just not in his power to solve it. He can help in various ways, but I don't think you could have anybody better, and I think he's done the right thing to this point, but the right thing may not be quite as effective as people may hope that it would be. In economics, you always want to ask, and then what? You'll read in the paper, well, what happens if the Japanese start selling our government bonds, or what happens if they dump the dollar? They can't dump the dollar. There's no way to dump dollars. You can, or at least dollar assets, because if the Japanese want to sell our government bonds, they sell them to us, they get a time deposit or a demand deposit at Citi, or they still own a dollar asset. If they sell them to the French, they may get some assets from the French, but now the French have it. I mean, the only way you can reduce foreign investment in the United States is to change it around so they're consuming more than we're consuming from them. I mean, when we buy a television set from Japan, if we buy more television sets from them than they buy equivalent consumables from us, the exchange, what balances things is we give them some investment type asset, whether it's cash or a U.S. government bond or our stocks or our movie studios or our real estate or different things. And the only way that reverses is when we start running a trade surplus, which we're miles away from. So logically, if you read classic economics, you would believe that our currency would have been weaker over the recent years, and that it would be weak now. But there are other things operating, and that's one of the problems about economics, is there's never just one variable. There's usually hundreds of variables, and they operate with different impact at different times. I mean, it's not like a physics formula. I mean, I guess it would be if you got into the Heisenberg principle or something like that. But the formula has a lot of the same variables year after year, but the relative importance of those variables and how they interact with each other is never exactly the same. And that's what we find out, the Japanese find out, everybody finds out. And foreign currency, or the value of our dollar and currency rates, are defying what you would expect based on history. But as somebody said, if history were a perfect guide, the Forbes 400 would all be librarians. They just go and look it up in the books and they'd always know all the answers. But history doesn't repeat itself, as Mark Twain said. History doesn't repeat itself, but it rhymes. I mean, things come back, but they don't quite come back in the same form. And we'll understand all this perfectly in a few more years, why the dollar's behaved the way it has. But I think it would be useful net for the U.S. if the dollar were less strong.